Are you worried about a potential US default or the dollar crashing? And if yes, which countries and assets might be safest for your money under such a scenario? Hello everyone and welcome back to Markets with Marcus. I hope you're healthy and well. So, as many of our Diamond NestEgg regulars know, and as we discussed in last week's update, linked below for your convenience, Secretary of the Treasury Bessent announced last week that he wants to intervene in the market to push down long-term Treasury yields, presumably to make borrowing cheaper for the federal government. Treasury yields did fall immediately after Bessent's buyback announcement, but this decline did not last. Per this CNBC article, the next day after the buyback announcement, we saw Treasury yields rebound, wiping out the decline following Bessent's intervention. In the end, the 20 and 30-year closed out last week almost exactly where they started, at 5.25 and 5.27% respectively. And to make it even worse, the value of the dollar against a group of 6 major foreign currencies, including the euro and the yen, as measured by the US dollar index, also fell sharply after the Treasury announcement. But, unlike Treasury yields, the dollar did not recover and ended the week down by 0.8%, which is not insignificant for a currency. The Wall Street Journal seemed worried enough to run an article about the return of the debasement trade, which is Wall Street's way of saying that investors flee the dollar for gold, Bitcoin, and other alternative assets. And last week's market uncertainty and volatility seem to have trickled into this week as well, after our government's announcement on Monday of economic sanctions on Iran. Now, personally, and as our Diamond NestEgg regulars know, we believe that it's not all doom and gloom, as many media headlines seem to be suggesting these days. For example, Bloomberg reported last Friday in this article that US business activity grew at its fastest pace in more than 4 years as stronger demand and a rosier outlook fueled a wave of hiring. So our standard assumption here at Diamond NestEgg remains the same as it's always been. The US is not going to default, and the US dollar will remain the dominating global currency for the foreseeable future. That said, the future is always uncertain, and we can't exclude a potential default by the US or a collapse of the dollar with 100% certainty either. No one can. So, given that some in our community want to understand their options in case worst comes to worst, here are the 3 topics that we'll be covering in today's video. 1. What are the 10 safest countries in the world for your money? 2. How might a sovereign default play out if it actually happened? And would gold be safe? And 3. How might you be able to protect your savings under a sovereign default scenario? Let's get started. What are the 10 safest countries in the world for your money? In our mind, a good starting point for deciding which countries might be considered a safe haven is their country rating, their sovereign rating as the industry calls it. So let's look at what the 2 major ratings agencies, meaning S&P and Moody's, are currently saying. At the time of this taping, on August 24th, 2026, there are 10 countries worldwide that hold AAA ratings from both S&P and Moody's. In alphabetical order, these countries are Australia, Canada, Denmark, Germany, Luxembourg, the Netherlands, Norway, Singapore, Sweden, and Switzerland. All are historically closely aligned with the US, and with the 3 exceptions of Australia, Canada, and Singapore, all of them are in Central and Northern Europe. Now, 3 comments on these ratings for a bit of context. First, ratings are not ironclad guarantees, but give us predictions and probabilities based on the information and expectations that the agencies had when they issued these ratings. These ratings can and do change over time with shifting political circumstances and economic fortunes. In real life, this means that the list of AAA countries has been shrinking for a while. Most prominently, the US lost the AAA rating from S&P in 2011 and the AAA rating from Moody's in 2025. Other major economies have similarly been downgraded from AAA over time, including Japan, France, and the United Kingdom. Which leads us to the next point. Second, some countries don't have perfect AAA ratings from both agencies, but may still be very safe. We already mentioned the US, which now holds the second highest ratings from both agencies, AA+ from S&P and AA1 from Moody's. But Austria, Finland, and New Zealand fall in the same category. Which leads us to our third comment. Country ratings, sovereign ratings, cannot be directly compared to ratings of private corporations. Historical statistics from S&P show that a country rated AA+, such as the US currently, is still much less likely to default on its debt than even a AAA rated corporate. And as always, if you'd like to continue these discussions with me, Jen, and our Diamond NestEgg members, and see where other like-minded, safety-oriented investors are investing for potentially higher yields, come on over and join our VIP investment club, where these conversations happen almost daily. And just in time to catch our member video this month on international bond funds and ETFs. Visit our website at www.diamondnestegg.com and click on this yellow Private VIP Investment Club button to learn more and join us today. So now that we've gone through the 10 safest countries in the world for your money, let's move to the other end of the spectrum and play out the worst case scenario in the next part of today's discussion. How might a sovereign default play out if it actually happened? And would gold be safe? Some countries have suffered from episodes of default and currency collapse in the past. So let's take a look at what happened to savers in Argentina after it defaulted on its debt in 2001. There were a lot of measures that were taken to stabilize the economy and the country, and they severely impacted savings and investments of ordinary Argentinians. Here are three of the key restrictions that the Argentinian government imposed after the default. First, the government froze nearly all bank accounts and limited withdrawals to prevent a bank run. They called this El Corralito, the corral or enclosure. Second, all foreign currency holdings in Argentina were forcibly exchanged into pesos, which meant these converted savings lost most of their purchase power in the hyperinflation that followed the government default. And, by the way, a broad segment of the population experienced this for themselves, because many Argentinians had been holding dollars as their supposed safe haven currency. And third, when the crisis persisted, the government even nationalized private pension funds and merged the savings into the public pension system, which resulted in less transparent and less generous payout schedules for retirees. What this shows us is that a government or nation that is under pressure may resort to extreme measures to save itself and its economy, and not much might be as stable and safe as people were hoping, not even gold. An episode from our own country from the more distant past can illustrate that. In 1933, the US seemed forever stuck in the deepest depths of the Great Depression, and the then new Roosevelt administration desperately tried to reflate and revive the economy. One of the first measures that the government took was to abolish the gold standard, and a joint resolution of Congress declared all gold clauses in public and private contracts null and void. This meant that all outstanding debts, including Treasuries, could now be repaid in legal tender, potentially devalued paper currency, instead of gold. Back then, and just as now, many investors considered gold the ultimate safe haven for their savings and felt cheated. They sued the government, but the Supreme Court ultimately took the side of the administration, and paper money it was, even for the holders of treasuries who had been promised gold before. And to make it even worse and add insult to injury, so to speak, also in 1933, Executive Order 6102 from President Franklin Roosevelt made it a criminal offense for private citizens to own gold bullion, gold coins, and even gold certificates, with only some very limited exceptions. The gold wasn't expropriated, but it had to be surrendered, sold, to the Federal Reserve for paper currency at a price that many investors felt was unfair. Now, all these actions did not amount to a default in the technical sense, but up to this day, some critical observers consider this episode something like a partial default or at least a debt restructuring. But if not much is safe in a country in an extreme economic crisis, not even gold, how could you prepare for a worst-case scenario, unlikely as it remains in our mind? Which leads us to the next section of today's video. How might you be able to protect your savings under a sovereign default scenario? So, there are three fundamental options here. First, you can bring your money out of the country. Second, you can hold foreign assets in your domestic account, your US account. And third, you can hold domestic real assets. Now, a US default would probably lead to a severe global economic and financial crisis, given the importance of our economy and the central role that our currency plays in the world. Most, if not all other countries would probably feel some effects as well. That said, and based on historical experience in other countries that have defaulted in the past, bringing your money out of the US may still be the safest method, and would, perhaps, provide as much protection as realistically possible in such a worst-case scenario. So, say that you've gone through the list of 10 countries with their AAA ratings from both S&P and Moody's, and have chosen one that you would be comfortable with as a potential safe haven. Or perhaps you have another country that better fits your own risk profile. At this point, you would still need to decide in which form you want to keep your assets there. The simplest and maybe safest approach might be to just open a savings account, or maybe buy local government bonds or similarly high-quality bonds with a bank or brokerage in that country. If you're a bit more adventurous, you might also add some high-quality foreign shares in companies that are not too exposed to the US market. Or perhaps you could hold gold or silver in physical form on the ground, if that makes you sleep better at night. Now, the US is an open economy and doesn't restrict international capital flows very much. And it is, in principle, perfectly legal for US citizens and permanent residents to hold property and accounts in foreign countries. And many do, for a variety of reasons. For example, because they worked in a foreign country for a while, like Jen and I did, as our regulars know, or because they've been building a diversified international portfolio. However, the US also taxes its citizens and permanent residents on their worldwide income, which triggers obligations for regular reporting to the IRS that can be quite cumbersome for you, your bank, and your broker. In fact, this is often the main reason why many foreign financial institutions are sometimes reluctant to open accounts for US citizens and permanent residents, especially if they don't have a valid address in or other connection to the country. Diamond NestEgg is not a tax advisor, but as someone who's filed taxes in the US, the UK, and Germany for many years, trust me when I say, please consult with your tax advisor before you diversify your accounts internationally, and don't underestimate the effort and the cost associated with this. Now, if this convinces you to not bring your money out of the US, but you still want to diversify your exposure a bit, then we can move on to option 2. You can hold foreign assets in your domestic, your US account. For example, you could buy US mutual funds or ETFs with underlying international assets or exposure via your US-based broker. Some US banks also offer accounts in foreign currencies. Or you could even buy foreign shares. Many foreign shares are traded as ADRs or American Depository Receipts on US exchanges. And foreign bonds can also be bought quite easily domestically. As our Diamond NestEgg regulars know, bonds from Deutsche Bank, a German G-SIB or Global Systematically Important Bank, come up from time to time in our videos on some of the highest yielding new issue investment grade bond offerings on the market. That said, most of these foreign bonds in the US are denominated in US dollars, so will not provide any currency diversification. Which brings us to option 3. You can hold domestic real assets to mitigate your risk of a potential US default or currency depreciation. This way, you don't have to go through the time and effort of opening accounts and holding assets in a foreign country or buying foreign assets in your domestic account. Apart from gold that we already discussed, and maybe other precious metals and commodities, real estate and shares in high-quality US companies with a good measure of international diversification might be something to consider. And of course, there are new asset forms such as cryptocurrencies, although crypto has not yet been really tested in a financial crisis. As you can see, there are a number of options for diversifying your assets if you are seriously concerned about a US default scenario, but none of them are easy or straightforward and will often come at a cost. Drop a comment below and let me, Jen, and the community know. Is diversifying a part of your portfolio internationally top of mind right now? And if so, which countries and assets are you most interested in? And are there any that we should consider doing a deeper dive into? And again, if you'd like to continue these discussions with us and our Diamond NestEgg members and see where other like-minded, safety-oriented investors are investing now for potentially higher yields, come on over and join our VIP investment club. This month's member video on international bond funds and ETFs will be coming out soon. Visit our website at www.diamondnestegg.com and click on this yellow Private VIP Investment Club button to learn more and join us today. Thanks for watching, and I'll be back.